Public sector governance. Part A. Compare and contrast public sector, private sector, charitable status and non-governmental NGO and quasi-NGOs forms of organisation, including agency relationships, stakeholders' aims and objectives, and performance criteria. The purpose of a private sector organisation is to make profit. Performance is measured usually with profit and market share. Private sector firms are mostly owned by partners, shareholders and lenders. Lobby groups may influence government policy to support their own goals, and that may work in favour or against the private sector companies. Public sector organisations provide public goods or services to the public which are not delivered by the private sector. Performance criteria for public firms are to meet social needs and provide value for money goods and services, which follows the 3E concepts: economy, efficiency and effectiveness. Part B. Assess and evaluate the strategic objectives, leadership and governance arrangements specific to public sector organisations, as contrasted with the private sector. When contrasted with private sector organisations, governance in the public sector can vary quite significantly, although it ultimately depends on objectives and leadership. The main strategic objective of the public sector organisations is the achievement of state-defined product or service delivery to meet social needs. In addition, securing value for money with taxpayers' funds is also one of the major strategic objectives of public organisations, while increasing profit and expanding market share are the major strategic objectives of the private sector organisations. In public sector organisations, key leadership positions are mainly occupied by delegated authority from the state. In contrast, in private sector organisations, leadership is decided by the board of directors, which is largely influenced by the shareholders of the company. In public sector organisations, governance is mainly managed by an oversight body, such as a board of governors. The main focus of the board of management is to demonstrate good use of public funds in meeting social needs. In contrast, private sector organisations work on principles or rules-based governance in order to satisfy shareholders. Part C. Explain democratic control, political influence and policy implementation in public sector organisations. Democratically elected executives, as in governments, are voted in after an election with a mandate to set public sector policy. When considering public sector policy provision, there are no right and wrong answers, unless based on factual inaccuracies. Public sector organisations must set their priorities according to the public demand, while formulating policy implementation. The following questions must be considered when observing factors that could influence public sector policy. Do companies provide society with everything they need? What if people face hardship? Should they get any help? Can we afford a public sector? Can we afford not to have one? Health, education and welfare are key priorities or not? Public sector organisations consider defence, business, foreign policy, environment, agriculture, arts, energy and transport as priorities or not? Public sector organisations also incorporate an agency relationship between the political leaders and the taxpayers. Because taxpayers and voters have differing interests and objectives, establishing and monitoring the achievements of strategic objectives and interpreting what is best for the principals can be very difficult. The agency problem in public services is also enhanced by limitations on the audit of public service organisations. In many jurisdictions the audit only covers the integrity and transparency of financial transactions and does not include an audit of performance or fitness for purpose. Part D. Discuss obligations of the public sector organisations to meet the economy, effectiveness, efficiency, 3 E's, criteria, and promote public value. Just like private companies, the governance of public sector organisations must meet the economy, effectiveness, and efficiency, also known as the 3 E's, criteria to promote public value. The prime purposes and objectives of a public sector company are to provide goods and services to the public, which is not delivered by the private sector. The performance of a public sector company is determined by its value for money against 3 E's such as economy, effectiveness, and efficiency. It is necessary for a public sector organisation to meet social needs. This can be easily performed by keeping the 3 E's principle in focus. Economy factor can be defined as obtaining inputs of the appropriate quality at the lowest price available. Efficiency aspect talks about delivering the service to the appropriate standard at minimum cost, time and effort. Effectiveness is a performance measuring feature which can be fulfilled by achieving the desired objectives as stated in the entity's performance plan.